Wherever you are, I welcome you once again to AE Accounting Tutorials. If today being your first time paying visit to this channel, kindly subscribe to be a member of this channel. And also comment, like and share these videos for the benefits of others. Today we are continuing our series on depreciation of non-current assets. But today we are focusing on accounting treatment for depreciation. I want you to understand some policies on depreciation. We have several policies, but I'm going to talk about two. One policy is that we calculate depreciation using each month's ownership. When we are calculating depreciation based on each month's ownership, when we are using each month's ownership, when we acquired an asset for, let's say 2020, but in March, we are going to calculate the depreciation based on the month, not the full year. So when we acquired an asset at the end of March and we have to calculate depreciation for that particular year, we are going to use the fraction of 9 out of 12. Is that okay? Because we've acquired the asset at the end of March, and first January, February, March won't be included. So the remaining 9 months will be taken into consideration. Is that okay? So when we acquire the asset for this month, for this particular year, we will calculate the depreciation because we are using each month's ownership. And the year of disposal too, we are going to calculate the depreciation based on the months we've actually used the assets. And we have other policy too, which is full year policy. With a full year policy, at the month of acquisition, we calculate the depreciation on the assets. But at the year of disposal, we don't calculate any depreciation. Irrespective of the month we dispose of the assets, we are not going to calculate any depreciation on the assets. That is for full year policy. Okay, but we have other policies to talk about. There are two key things that actually brings out the double entry for depreciation. That is when you acquire an asset and when it gets to time for disposal. Is that okay? So we are going to look at the vital accounts that will be actually affected when there is acquisition and disposal of assets. So when this happens, I'm required to prepare the asset account. The asset account. 2, may be required to prepare provision for depreciation account, provision for depreciation. Account. And 3, asset disposal account. Account. And 4, probably the profit or loss account. Alright. Sometimes you may be asked to actually prepare the statement of financial position extract, and the profit and loss account is an extract. Is that okay? But these are the 3 core accounts that you will be required to prepare as far as the double entry is concerned. So, but before we look at the double entry itself, let me use this simple scenario to do this analysis. Alright. Example: maybe you've acquired an asset. Okay? Acquired an asset. Maybe an amount of 10,000 cedis, and there was depreciation on this asset of 10% on cost. Alright? And you actually dispose of this asset, that is disposal, of an amount of $4,000. Alright, we assume that you've acquired the asset on 1st January 2020 and you are disposing it off on 1st January 2021. We assume that in the full year policy. So let's actually look at how the double entry will go. As I said it earlier, when we have the asset account open, you your asset account. Then next will be the provision for depreciation. Provision for depreciation. Account. Let me introduce this account for the purpose of the double entry for better understanding. So let's talk about the cash account too. This is not relevant to this, but for the purpose of the double entry and for better understanding. And we also talk about the disposal account, that is the asset disposal account. Let's talk about the profit or loss account, and this is always extract. And you may also be required to prepare the statement of financial position extracts. This is just an extract, okay? So we are going to look at how the double entry will go. We are much aware that with the statement of financial position, we will definitely have our costs. We have accumulated depreciation, then finally our net book value. Alright, so we are now going to look at the double entry. So when we acquire an asset, okay, anytime we acquire an asset, the double entry is that, let's assume that we acquire the asset with cash. So anytime you acquire an asset, cash is going out. So you credit your cash account and debit your asset account with the amount you used to actually buy the assets. So we are crediting cash account in the name of asset, and the amount is 10,000. Then we come to debit the asset account in the name of cash, 10,000. Alright? But before that, let me chip in this. This asset account, it is a cost account. We only use it to record the cost of the assets. Is that okay? We are not going to record any other amount, either disposal, even if we dispose of an asset. We are going to use the cost in recording, but not the amount we use to dispose of the asset. Is that okay? So that is its purpose. And this asset disposal account, it acts like the profit and loss account. We prepare this account to actually find the profit or loss on disposal of the assets. Is that okay? So at the end of the double entry, you actually testified what I'm talking about. So this is basically the double entry for acquisition of assets. Is that okay? So from this scenario, we have depreciation of 10%. We know that for tangible non-current assets, the standard requires us to normally make provision for depreciation. And the depreciation itself is an expense, and at the end of the period, we are going to actually match it against revenue in the income statement. That is why we have the income statement over here. That is the profit or loss account. So anytime there is a depreciation or provision for depreciation, it is just a provision. So we are going to credit the provision for depreciation account and debit the profit and loss account because depreciation is an expense. So we credit this account in the name of the P&L account, that is profit and loss account. And the depreciation is 10% on cost. 10% on cost is 1,000. Is that okay? Then we debit the profit and loss account in the name of provision for depreciation account. So depreciation 1,000. Okay. So we are done with the depreciation. Okay, the entry for depreciation. Now we are going to look at how we also account for disposal of an asset. Is that okay? So anytime you dispose of an asset, it means you are selling the assets out from your business. So we are going to take the asset completely from your book. So the entry is that we are going to credit the asset account and debit asset disposal account. Is that okay? So we are crediting the asset account in the name of disposal, an amount of 10,000. But mind you, we dispose of the asset of an amount of 4,000. But when we are to do the entry in the asset account, we are not going to use the amount you sell the asset, but rather the cost of the assets, okay, to close off the account. We assume that at the end of the period, because we are selling off this asset, there shouldn't be any carrying amount or balance brought down at the end of the period. We want to close down this account. So we record it with a cost to close off this account because we sold these assets. Is that okay? Then the corresponding entry will be the debit side of the asset disposal account in the name of assets. $10,000. But mind you, I'm using an asset as a general name. But in a question, you may meet a specific asset, maybe a motor vehicle. In that instances, you are going to represent this asset with motor vehicle account. But I'm just using the asset as a general name. Okay. So when we dispose of the assets, we now close the asset account and we made the debit entry in asset disposal account. But mind you, there is a depreciation on the asset, that is the accumulated depreciation. Because we are taking the cost from the asset to close off the asset account, we have to actually take its depreciation from the provision for depreciation account. Because this asset is no more in the business, so we shouldn't have any depreciation for it in our book to actually match it against any revenue in the income statement. So we are going to take it from our provision for depreciation account. So for the depreciation, we are taking it, and the amount is depreciation. The amount is 1,000. And because we are disposing, we have disposal. Every debit entry must have a corresponding credit entry. So we are going to credit the asset disposal account with an amount of 1,000 cedis. So in the name of depreciation or accumulated depreciation, 1,000. Alright? But mind you, when we dispose of the assets, how much did we get from it? And this account, I told you that we prepare this account to know the profit or loss on the disposal. So we are going to credit the asset disposal account. Okay, we dispose and we receive cash. So when we receive cash, we come in debit from the disposal. We disposed and we got cash, so disposal. And the amount was 4,000. We are going to credit the asset disposal account from, that is cash, or proceed on disposal, 4,000. Alright? So we are done with the double entry. So basically, this is how we actually made entry when we acquired an asset. At the same time, we dispose of an asset. Is that okay? But before that, let me actually close this account to know the profit or loss on disposal, so that we transfer the profit or loss to the profit or loss account. So we have to close off this account. We'll be having 10,000, and the difference here is 5,000 cedis. And this will go to the profit or loss account. It is found at the credit side of asset disposal account, so it will be at the debit side of profit or loss account in the name of disposal. 5,000. Mind you, anytime the difference is found at the credit side of the assets disposal account, that is a loss. They will debit the profit or loss account. But anytime it is being found at the debit side of asset disposal account, that is a gain or a profit. So we credit the profit or loss account. Alright. So from this analysis, if you are being asked to actually make a statement of financial position extract, you just come and bring the assets. That is, and then on current asset, the cost of the asset is 10,000, and its accumulated depreciation over the years is 1,000. But mind you, this account has been closed. 1,000. Then you bring the accumulated depreciation. Then the net book value will be 9,000. So basically, this is how the double entry for depreciation or the accounting treatment for depreciation goes. But in our next video, in our next video, we are going to take a full practical question where we will be asked to prepare the asset account, the provision for depreciation on the asset account and the asset disposal account, probably the extracts. Is that okay? So we'll be taking it, and it is a full complex question where we'll be asked to do so many things. And if you haven't subscribed to this channel, kindly do so. Like, comment, and also share this video for the benefit of others. But then, until we meet, I think bye for now.